our initial idea was to extend some of the heavily researched ideas on spot and forward contracts in foreign exchange and extend them to analyze volatility instead of the level of the exchange rates. Yeah, the basic idea is that the forward market, if markets are efficient, should be providing us with expectation of where the exchange rate is going in the future, which are correct on average. Now, that simple hypothesis has been heavily tested for over 30 years, ever since Eugene Fava at Chicago started working in this area. And what we know about that relationship is that the forward market does not provide unbiased expectations of the future exchange rates, so does not provide us with any evidence that the basic theory behind this relation is correct. Now, we extend these ideas to the volatility market, and this is really exciting because in the last 10 years there has been an explosion of contracts, derivatives contracts, which essentially allow us to trade the volatility of an exchange rate as opposed to trading the exchange rate itself. Under the same assumptions as standard market efficiency and risk neutrality, behind forward unbiasedness, we would expect that the forward market for volatility contracts provides us with an unbiased expectation of where volatility goes in the future. In other words, with an expectation which is correct on average. And what we find is that this basic theory, this basic forward unbiasedness hypothesis, which we term the forward volatility unbiasedness hypothesis, is rejected by the data. Just like the standard unbiasedness hypothesis is rejected in the conventional spot and forward market for foreign exchange. And that forward bias gives rise to a risk premium which we quantify in this research. So in addition to providing statistical evidence that documents the rejection of this basic theory, more importantly, we find evidence that these statistical findings are economically very important because the risk premium arising as a consequence of this bias is very large. The most striking part of this new risk premium, it's essentially a volatility term premium, is that it appears to be very different from any other risk premium in the foreign exchange market. So it's not correlated with the traditional risk premium. It's also not correlated with the other conventional risk premia that we know about in asset markets. So in a sense, we think we found a source of risk-adjusted returns for asset managers that is new, is coming from a different kind of anomaly, if you want, that we didn't know about before.